Hi, hello everyone, welcome. We're just letting everybody coming in and joining us. Hello everyone. We just had meeting everybody in the main room, and we will start in a few minutes as soon as everybody is here. In the meantime, just you are currently muted. You're welcome to have your camera on and off. And for the purpose of the session, and for those who register but could not attend, we are also recording this session. And we will share the recording with you later on. So welcome everyone. You have 30 seconds to go and grab a glass of water if needed, and then we will start. Feel free to introduce yourself in the chat room whilst we're waiting everybody. This session is Masterclass 11. We had a series of masterclass since the beginning of January. Part of it is because we are delivering a program for the FCDO, Act for Green, an accelerated programs involving UK and Indian startup, and most of them will be joining us today. It's also open to our Oxfordshire Cleantech members and to our Cambridge Cleantech members. So welcome everybody. Okay. Today I have also helping me Oriane, and Oriane is unmuting you in the main room.
Hi everyone.
Can you please let me know, Oriane, because I can't see if everybody is in now.
Just a second.
Yeah.
Yeah, they should be all in now. I'll let them in if there's any later on.
So yeah. So thank you everyone. Let's start now. This masterclass is all about numbers. So you do use numbers not only when you go and meet some customers, but also for your pitch deck if you're presenting at the Cleantech Venture Day, for example, or for any other pitch decks. So today we have an expert, Jeremy High from the FDC Center, and he's going to let us know how to make sure that our numbers work for us, talk for themselves, and just make the impact they need to do. Jeremy, over to you. I'm just going to stop my screen.
Thanks for that, Sylvie, and good afternoon, or good, yep, we're just into the afternoon. Good afternoon, everybody. So, as Sylvie says, Jeremy Hyde, I'm a finance director. I'm actually now the regional director for the FD Centre. So we provide part-time finance directors to SMEs that are too small to need and probably can't afford a full-time finance director, but they do need a seasoned, experienced finance director to help them grow their business, take their company to the next level. It might be fundraising, as we're talking about today. It could be selling a business or putting in the right systems and processes, whatever that is. I have a 30-year career in finance, started as a finance manager, and after qualifying, I moved on into industry with, first of all, GlaxoSmithKline, and then one or two other corporate organisations. And I joined FD Centre about 3 years ago because I felt that with my experience coming into the SME community, I really like SME businesses, and it's a great way to support an important part of our economy. So today is all about Masterclass 11. It's all about the finance piece of your investment pitch, your pitch to investors, whether that's a 5-minute pitch or a 10-minute pitch, which we sometimes have with Cambridge Cleantech. I'm going to focus on the finance aspects of that pitch, and I'm going to attempt to share my screen now and then share with you a presentation which will cover the key elements of the financial part of your presentation. So hopefully you can all see the screen now. So,
yes, all good.
Oh, great. Thanks, Sylvie. So just to context this and put it in perspective, if you've got a 5-minute presentation to investors, the majority of that, say 4 minutes or so, is going to be all about the concept, all about the idea. And the most successful pitches get into that emotional space. We are creatures that make decisions based on emotions, and investors are no exception to that. So they'll want to be caught by that compelling opportunity that you talk about. And that will get them nicely into that emotional space and feel enthusiastic and passionate about your business. And you portray that and they'll feel it as well. But inevitably, as everybody does, but particularly investors, they'll go from that emotional, this sounds great, to, but what about the numbers? What about the financials? And then we move back into that boring, logical box that we need to then start to think about numbers. And just to put it in perspective, for your 5-minute slide, 5-minute presentation, it's probably 2 slides, 1 or maybe 2 slides, and it's probably between 30 and 60 seconds of your entire presentation, if it's a 5-minute presentation, but nevertheless, really important. So today, I'd like to go through the key steps that will prepare you so that when you do that 30 or 60 seconds, you're not only showing the right information on the slide, but you're also coming across really well, and more importantly, you feel comfortable about what you present. So what is the investment context? What is it that the investors are going to be looking at when you talk about the finance piece? Well, how much is it? Sounds obvious, but it's really important. This is what we're looking to raise. This is what we need. And then what are you going to use it for? And I don't mean a detailed analysis of what you're spending the money on. You know, we're going to spend this on staff costs and we've got these materials and these overheads. That's not what they want. They want to know the nature of the spend. Is it to prove a concept? Is it to establish a manufacturing facility? Or is it a sales and marketing campaign, or a combination of those things? The nature of what the spend is for is really important, and how that links with the overall opportunity. Then we get into the return on investment. So really happy about the idea. Now they know what you want it for, but what's the return? If I give this money over to you, what am I going to get back from it? And that's where we come into the financial model. I've put in here as well valuation, and it's not your role to tell the investor what the value is. The investor will work out what they think your value is. But clearly one of your roles is to generate an opportunity in the minds of the investor so that they're coming up with a number or a value that is what you're kind of thinking maybe. And in any investment pitch or investment raise, you're looking probably to raise around 20, 30%. Give away around about 20 or 30% of the perceived value, the equity of the business. So what I mean by that, for example, is if you needed to raise £1 million, that was what you needed, given you've done your numbers, I need £1 million, then you'd be looking for them to be thinking the value of your business to be around 3 to 5 million, 20 to 30% of the value. So let's talk about the model and the financials that sit behind that return investment that I allude to. And your idea, your concept is going to be based on a business strategy, or should I say the market opportunity, and how you're going to exploit that is based on a business plan, on a strategy. And that will be your sales and marketing strategy of how you're going to reach out and create the demand and attract customers and sell to them. It's also going to be your operations plan, which is going to be how you actually deliver the products and services to the customers. And then underpinning all that is the financial plan. And within that is that ensures that it is financially as well as commercially viable. And it also identifies what your funding requirements are going to be. So let's just go through the key steps or the key elements of what your financial plan is. So you've got your revenues and costs, which give you your profits, cash flows. So you've got profits and cash flows, equally as important. Also with the model is being able to understand what are the key assumptions. there are certain assumptions in any plan that will be key, i.e. a small movement in those can make a big movement or big difference in your final output, in your profits and your cash flows. So understanding what those key assumptions are will be important. And then having the ability to be able to run scenarios of different values of those key assumptions, which we call sensitivities. How sensitive are your numbers? How sensitive is your success to some of these key assumptions? The model is effectively a set of accounts looking into the future, which is an integrated profit and loss, balance sheet and cash flow. And if you're looking for a big fundraise, when you get to the next stage and they're looking at the due diligence, then an integrated model will be important to give credibility to the numbers and also to make the investors feel comfortable. So what are the key constituents or steps in the financial plan? First of all, profit and loss. And your profit and loss is calculated from understanding revenues. And I've got another slide on revenues, because revenues is probably one of the most important aspects of your financial model. Because to an extent, if you understand what the revenue, once you understand the market opportunity and the revenues, then everything else kind of follows that. Your costs of sales, which make up your gross profit, the investments that you need to make in promoting the product, your sales and marketing activities, and then your overheads that are associated with running your business. So things like the head office, rent of the office building, it might be your CEO and your reception area. It could even be, as your business grows, it will be support functions like HR and IT. So your revenue, your sales, less all of your costs, gives you your EBITDA. And EBITDA is the key number that the investors are looking at. That's the closest number you get to your underlying operating profitability and cash flow. Also in P&L, we have some other items that follow after EBITDA. So depreciation, that's recognizing the assets that you need to invest in the business. So there are some costs that you incur, which that it might be to buy some plant or equipment or a vehicle. And it would be wrong to put all of that cost into year one when it might have a useful life of 5 or maybe 10 years. So by dividing that across the useful life, we get a better feel for what the underlying net profit of the business is. You also have financing for the costs of your loan, interest if you've got debt finance. That gives you your profit before tax. There's also things like taxation and dividends and all those items. I'm going to focus today very much on the operating profit and loss, which is the key, and EBITDA, which is key for your investors. I said I'd return to revenue because revenue is the single most important line probably in your plan. Everything else follows the revenue. And your revenue numbers, they start with the total market opportunity. And there's a word that you'll see, well, there's a number of acronyms around here. There's TAM, SAM, and SOM. This is all about the total market size. And the first, at its most primary level, is the total addressable market. And what you're looking for in your presentation is a really big market. If the total addressable market was, say, £2 million, is probably not worth starting that fundraise. If it's $1 billion or trillion, that's when investors get excited. Because if they can see this great big market, then they get excited about the return that they might be able to make by investing in you and your business. And as I was mentioning earlier, you have TAM, you have SAM, which is then the serviceable market. So for example, if your product was in one language, then your TAM would be the whole world, but then perhaps the SAM would be those countries that speak in the language that your product is in. That's just an example of it. And you have SOM as well, which is really the realistic market that you're going for. That's the market that is a realistic potential first step for you as a business. And of course, what's important here is we have this big market opportunity worth $1 billion. This is what we think we can go for, still a sizable market. And now we're going to talk to you about how we gain market share in there. Our sales and marketing plan, as I alluded to earlier, how we're going to advertise, promote and sell to our customers and build that market share, build that volume. And the volume is the key assumption, the volumes going through the year, times your price, that gives you your revenue. Pricing is another key area. And this is, the pricing will be a key assumption for sure. If you double the price, that can do make quite a difference to your output finally. And there are different prices that you can go in at, different niches within the market. So that will be a real strategic decision and journey that you'll take as well to identify what is the right price. But price times volume ultimately will give you your top line sales numbers. And from there, we can work out the rest of the P&L. In addition to profit and loss, of course, we've got the cash flow. Cash flow is the lifeblood of your business, and businesses cash is, and there's a saying, and you've probably all heard it, cash is king. The most profitable businesses can sometimes run out of cash, particularly if they're growing rapidly in the sales line. So cash flow is your engine fuel. That is the key. And the investors will be interested to see what is the cash flow, what are the risks on your cash flow throughout your plan period. So calculating cash flow, a lot of it comes from the P&L. I talked about the integrated P&L, balance sheet and cash flow. So here we're looking at revenue, and this is the income that you're receiving from your customers. So you have your sales, and then eventually those sales which are invoiced to your customers will turn themselves into real cash into your bank account from your customers ultimately. You have your costs, and there'll be the cost of your direct costs of producing the products or services, and then of course your overheads. Within the cash flow model, you have working capital, and this is all about the timing between when you incur costs yourself, making the product or providing the service, to when you actually receive money from your customers. And the longer that it takes between you incurring costs in raw materials and components and staff to provide the product or service, and when you actually get paid by the customer, can be 2-3 months later, that time period requires you to make investments. And that's what we call the working capital. And we'll touch on that in the second session. So we're doing 2 sessions this afternoon, half an hour theory, a few questions, and then I'll share with you a model, and we'll look at the impacts and how working capital works and those timing differences. You'll also have capital expenditure. You can't produce anything or provide a service without some form of capital, probably. So within your cash flow model, early on as well, before you're probably generating revenue, you're going to be needing to invest money in capital. And this could be a key part of your reason for your fundraise. So that is effectively all of those numbers, the receipts from customers, the money you'll spend on working capital and your capital investment gives you your funding requirement ultimately. So having done all this work and prepared your P&L, prepared your cash flow, you're now in a position to present the numbers in your pitch. And I would say no more than 2 slides and possibly 1 slide. And here's an example of the key numbers that you want to be presenting. So we have EBITDA, as I mentioned, is a key profit indicator that investors will be really interested in, particularly on when it becomes profitable. In this example, and I've deliberately used the word period rather than month, because it would be unrealistic to say that a business could, because very often businesses can take years before they start becoming profitable. So these could be blocks of quarters or 6 months. But in this example, we see that we're running at a loss in the first 4 periods, and then in period 5, we start to make a profit. The more important number is cash flow. And as you can see from the slide here, this business starts with an investment requirement of 750,000. And in the first period, it invests capital and working capital. And you can see the burn through of cash as the business goes. And that's a natural phenomenon. Any business looking for funding, it's going to spend that cash over a period of time. And it's all about forecasting forward and understanding when you might need to do another fundraise, when you're going to start becoming a cash positive business. In this example, we get very close in period 6, and I would suggest that's a bit close for comfort, and possibly we'd look for another fundraise a little bit early on there to avoid that. But you can see we're almost running out of cash at period 6, and then we really take off as the profits of the business convert to cash. The other slide, which is also a valuable slide, brings in revenue. And investors are interested in that top line. How does that revenue curve look like? When do we start producing revenue? And in this case, as you can see, we start producing revenue in period 4. And the gross profit, which is effectively your revenue less your direct materials and staff costs incurred in providing that product or service, follows that revenue line to some extent. And then we have the EBITDA, which takes account then of the fixed and discretional overheads associated with your business. And as I mentioned, this is a 30-second, 1-minute presentation covering those aspects I talked about: what you need to borrow, what you're going to spend it on, and here's the return on investment. This is a good point to just break and just see if there's any questions, and then I'll move on to the model and share with you the numbers that sit behind some of these slides.
Thank you, Jeremy. So I've put a few summary of the time, the sum, and the sum in the question in the chat. We have one question from Emma. Emma, would you like to take the mic and just join us?
Hi everyone. So Jeremy, I was wondering, do you have any advice for companies in terms of how they can work out the percentage they should invest in marketing as a percentage of projected turnover?
There are sort of, you can use benchmarks. There are people that say it, but it really differs according to what industry and business you're in. And my experience is benchmarks are interesting, but actually every company is unique. And I think the path to profitability and cash flow is what drives it. And playing around with those scenarios that I mentioned, because if you invest double in the sales and marketing, it's a good chance that you'll accelerate the sales growth and you could grow quicker. And I think a key assumption that I mentioned, and investors are often not so much in your 5-minute presentation, but later on in the due diligence, when they start getting closer to the business and the plan, they might throw in there, what about if we spend double on the marketing activities? What could that do? As they get to understand what the different marketing and sales and marketing activities are and what the potential returns can be, they might play around with that, and you could end up with some different scenarios in the level of investment that they might want to make.
Okay.
Does that answer your question?
Yes, and I think it depends whether it's consumer focused or B2B, because consumer marketing will require, much bigger sort of funding pot. Yeah,
and it's it's one of the great quotes from Wanamaker. That was it, Wanamaker from the 1800s. He was a real marketing pioneer for his time, but he says, I know that half my marketing is wasted, but the problem is I don't know which half. So this is a great example when you're doing the branding and that sort of to consumer, where you've got the macro market. The investment you make is really hard to tie into what the output's going to be and what the sales that you make. Whereas B2B is a lot easier, particularly now that we a lot more online marketing where we can trace back what those initiatives and activities have created in terms of individual customer orders and demand.
Yeah, that's why it's important to have KPIs and to be measuring all these things. Yeah.
Absolutely.
Okay. Great. Thank you.
Is there any other question so far?
Great.
Alan.
I spoke too soon. I was about to say great, because I'd like to spend as much time on the model as we can. So
okay. We've got one question from Alan, and then we move on. Alan?
Yeah, I'm just wondering how to figure things a bit more. If you're coming in with more of a product design that will to sell on, maybe through licensing,
Yeah.
or develop into a product of a vehicle that you can make into a whole vehicle. So how does that fit in with your forecasting, etc.? You haven't got you can't say, it's not like a 6 eggs or something, they're worth this much, and I could do them half the price or something. It's very difficult. I mean, when you've got a couple of ways out, you go into your own product with your design or whatever, or licensing, and then predict or forecast from that.
Yeah, it's a good one, Alan, because it's in the example I'm going to give. It's a manufacturing business, and there's always an option. And if you're an early stage and it's a big market, sometimes contract manufacturing or licensing is an option, and it's a sensible option if you can't raise the finance as well, because sometimes people might not be prepared to invest huge chunks of money in an idea, but they might be up for investing in a concept that you bring to a product that then your intention is to either get it manufactured externally or under license, marketed, produced and marketed around the world and in the market. So I would always think of it as being an option for you. If you've got this idea, I would look at both in your strategic and financial planning. If I was to adopt the licensing methodology, what would I do here? Would I just license out the manufacturing, or would I be licensing out the sales and marketing as well? Because sometimes if you've got a product where there's other sellers out there who have huge market share and huge presence in the market, they may well be able to accelerate the take up of your new product idea. And it might be more financially rewarding for you and potentially investors, if you're presenting to investors, to go that route, and there might be less risk. But I would have that as one of your options. How to model for it? It's basically looking at what the cost is going to be for you to get that to the point where someone will be interested in paying you a royalty for licensing it, or if it's manufacturing. Once you understand that, then the different ideas of how that's going to work, what sort of royalty you'd be looking at. So those revenue calculations and considerations that I talked about will be really relevant. It's what's the total market here? What do I think the pricing is going to be in the market? And then what realistically market share do I think I can get? With these big strategic marketing partners, it could be quite big. So you work that through, you work through your volumes, and then at that point, you decide on what a royalty level that you'd be looking for. And then you'll see how that cash flow works through the plan. You'll see your investment up front. You'll see the royalty income, and the investor that's you're pitching to says, I'll invest $1 million in this because that royalty income that's going to happen over the next 10 years looks really interesting. Or you might try and adopt and do the whole thing yourself. But of course, it's harder to get more money up front on things like that. But there is a way that will work through your model. And I can touch on that as we go through the model, if you like, just to say where you'd put that in the model.
Yes, thank you.
Thanks. So let's carry on, Jeremy.
Okay, so I'm going to share my screen again. This time, it's the FD's best friend, also known as the spreadsheet. You can never do a fundraise without a spreadsheet, guys. So I'm just going to move on to that, and hopefully when I press this button here, you will see I don't think you can see that, can you?
We can see your screen, so we can see your Excel spreadsheet as well as your PowerPoint.
In that case, I'll expand it. Is that clearer for you?
Yes, it's good for me.
Great. Okay. So back to the financial model. The real dry stuff now. My apologies. I get excited at these things because I'm a finance director. So the first element is your profit and loss. And as I talked about earlier, the two elements that I have here are profit and loss and cash flow. Now, what I'm not going to try and do in the next 20 minutes is introduce you to an entire fully integrated P&L, balance sheet and cash flow. One, I think it would bore you and you might leave the call early, but two, there's just too much in there. What I want to do, my purpose for you here, is really just get you set up for that initial presentation and those slides, and be comfortable that you've gone through the thinking that creates the set of financial numbers that you're going to share with potential investors. So we look at first at profit and loss, and it all starts with revenue again, as I mentioned earlier, understanding that total market opportunity, converting that down to what you think that you can achieve in terms of sales volumes over the plan period. Volume times price, and that gives you your revenue. So in this, as you can see from earlier, these are the numbers actually that sit behind the graphs that I shared earlier. So we plan to sell 100,000 in period 4. Just to make this a more realistic case study, I've pretended that Component Co company is, we've discovered a way to produce solar powered batteries or power units to operate mobile phones. So you can imagine the size of that market. Like every mobile phone in the world can use this. No more plugging it in to use the cost of the power. So your TAM here, your total achievable market, accessible market, is every mobile phone in the world, plus the spend on power, recharging your phones. So that's the case study. In my case study, I've assumed that we can sell these power units for £1 each, and the cost of making them is going to cost us 20 pence for every pound that we sell for 1 unit. It's 20 pence in materials and components, and it's 30 pence in direct labour costs, using machines to put these things together. So that gives you a gross profit of 50 pence, which is pretty high and probably higher than you would normally expect in a business. But I've used that just so that we can accelerate when we get into profit and the cash flows. So in my example, with all our sales and marketing effort, we open the business at the beginning of period 1, and we start manufacturing straight away. We also start selling marketing, and we reckon that by period 4, we can now start selling, and we'll create enough demand to create these sales volumes and figures in those first 12 periods. I'm going to skip the opening stock at the moment, go straight to purchases. So this is your raw materials and components that go into the power units. And then you have the direct labour. So we've got £25,000 worth of direct costs here. And a great assumption I've made here, which is totally unrealistic, is that there aren't any losses. There's no rejects, batch rejects or damaged stock. Everything works smoothly. In a model, you would, of course, put in some assumptions around that. But at the end of period 1, we're predicting that we will invest 25,000 of direct costs and produce £25,000 worth of stock. And at our sell price of £1 per unit, this equates to £50,000 worth of sales value. But of course, in your model, stock is always going to be valued at the cost of producing it rather than what you sell it at, unless, of course, you're selling at a loss. But that won't be a case in our business. We do have some fixed costs. We've got sales and marketing and administration costs. So from day 1, we set up our head office, got IT and HR functions, and got our rent and rates. We've also got our sales and marketing staff and the advertising spend that we're doing. Typically, some of those things will be done quarterly. When we get into cash flow, I'll explain that in more detail. But ultimately, in the P&L, you would see those in month. So as you can see, first month, we're making an EBITDA loss of £30,000. Now see that is only the overheads. All the costs of manufacture have gone into making your stock. So you don't need to release those to your profit yet. So it looks like you're only losing 30,000 in profit and loss, but you've probably spent a lot more, as we'll see from the cash flow later. You also have the depreciation, and there are spaces for the sort of tax and dividends and interest. But our focus today and your focus for your meeting, your presentation pitch is all about EBITDA and operating profit and cash flows. So you can see how this works as you gradually grow through the period. Your costs of materials and wages will gradually grow through the period. So by period 12, you're producing goods worth just think like 1.2 million in cost, which is actually 2.4 million in sales value. So a huge ramp up through the period. And I spent probably around 5 minutes going through this, and you've had time to look at it and absorb it. But a picture paints 1,000 words. How you present this in your 5-minute pitches will be by a graph. And this is the graph which shows you the revenues. The green line is the revenues. So that gives you a feel now for the shape of the growth here. You can see you start producing revenue in period 4, and you can see how that's moving forward. And then you have your gross profit and your EBITDA. So that's the profit and loss, key element. And your model starts with that. It starts with those assumptions of the market and what sort of volumes you're going to sell, and then how much it's going to cost you to make that and what you need to make it. That's where it all starts. And then we start to get into the cash flow, and which is the most important aspect, particularly in the early stages of your business. So I'll now move across to the cash flow. And I mentioned earlier that ideally your model ultimately will be an integrated model, so that when you move assumptions in profit, you know, assumptions about your revenue, about your costs, they will automatically update through the model, and they will update your balance sheet and your cash flow. So let's just go through the elements of our cash flow in this case. So as you can see from here, we don't get any cash from customers until period 5. If you remember, when I presented the P&L, we said that we sold 100,000 units in period 4, and we don't actually see any cash until period 5. So the assumption in this model is that we will give our customers 30 days credit. So we invoice them, we supply the goods or provide the service, they pay us 30 days after the invoice. And a bit like sort of manufacturing losses earlier, I've assumed that everybody pays you exactly on the day they're supposed to pay you, and all is rosy. In the real world, it doesn't work like that. You get delays from customers, you get disputes, you get bad debts, and sometimes write-offs. So again, your model will need to reflect some of those assumptions and sensitivities. But for the purposes of our model here today, this is the revenue coming in a month after we've actually sold the products. Turning to the costs and how we manufacture the products and our other overheads. First of all, purchases, the raw materials and the components. You'll see here that we haven't actually started to pay anything until period 2. And a bit like your sales to your customers, you're actually paying your suppliers 1 month after you've received the components and raw materials. So we used those materials in period 1, we paid for them in period 2. So there's a bit of relief on the cash flow for this. We then move down to wages, and the assumption here is that anybody, your staff that are involved in making the products, in this case, you're paying them in the same month. The reality is that actually wages, you pay the wages in the same month, so the net pay goes to the employees in the same month. But PAYE, pension, and NI would be paid to employees the month after. That becomes due partway through the following month. So in your model, you would reflect that cash flow. We also have sales and marketing. So we talked about the fact that you really need to start spreading the word, creating the noise in the market. That starts on day 1. So you're incurring costs in advertising, sales staff and promotional activity from the beginning, as is in the admin. Now, of course, in administration, you've got some salaries in there, but there'll be things like rates and rents. Rents very often can be paid quarterly in advance or even half yearly in advance. Sometimes they're paid partway through. those sort of things would need to be reflected in your cash flow. But for the purposes of this model, simplified model, our cash flow is in same month. So what's the net impact of all of that? Well, this shows that you, in the first month, you have an outflow of cash of £45,000. That's a bit different to the £30,000 EBITDA that we saw. So immediately there's another 15,000 in there. So what makes that up? This is all about what I call the working capital that I referred to earlier, the timing difference between profits and cash flow. In our profits, all of that time spent with the employees making the products and the raw materials and components you had, they were valued into stock, so that you didn't take the loss in the P&L for that. You only took the loss in the P&L for the sales and marketing and the overheads. So that's the key difference here. So you've invested in working capital, as you can see, as we go through those periods. In the first 6 periods, you've actually invested 375,000 in working capital, and you've only just started getting cash back from customers. So this puts a strain on your cash funding. But not only that, not only do we need to invest in working capital for the timing difference, for the producing and providing the services, we also need to invest in capital. Inevitably, any business will need most business will need some form of capital up front. In our example, we're renting some premises, so we've got the site, the warehouse. We're looking to invest in some equipment, some production facility. We also need to kit out our offices, and maybe there's a sales suite in there as well. So we predict in our model, we need to invest 350,000 in capital, and that needs to happen up front. You need to do that in front of your first day of trading, really. So it's a bit ambitious to think that we can invest in that capital and produce £25,000 worth of stock in period 1. It's in the real world, you're likely to spend months or even years building your factory and investing your capital before you start to operate. So overall, if we look at the investment in working capital of 350,000 plus the investment in capital of 350,000 plus the working capital requirements, already at the end of period 1, you've already spent 395,000. And that spend continues with the working capital. So you can see the level of spend required. So we work out that given the nature of the spend, we need to borrow £750,000. And again, picture paints 1,000 words. How do we describe this to the investors? That's the graph that I showed you earlier. So this is the picture. This is the big picture that the investor is interested in. How does my EBITDA move through the period? And how does my cash flow move through the period? And they'll be particularly looking for, in the cash flow, how quickly can we turn the corner and start generating cash flow? And how close do we get to the mark of zero cash? Because that's a risk area. This is, in fact, far too much of a risk. You wouldn't move that closely to zero in a model typically. And what I can do, because we've still got a little bit of time, for example, let's assume in our hypothetical example that that initial investment in capital can produce, it has a capacity of around 500,000. We can see that by period 9, we're already producing over 500,000, selling more than 500,000. So we're going to have to get to the point of being able to produce more than 500,000 fairly quickly. So let's assume and give ourselves a little bit of slack as well. Let's assume that we invest in a new machine at this point. So we put in 400,000. So there's our 400,000. And this 400,000 investment actually is going to increase the capacity. It's going to more than double the capacity. So our initial investment gave us 500,000 units per annum, per period. This new investment, that doubles it. This is 1 million. This can produce 1 million. So you've now got a capacity of 1.5 million. And you can see that covers you for beyond period 12. But what does that do to our cash flow? That's the issue. And it's probably better shown on our graph. here you see that investment in capital there means we go into the red. We need another fundraise to get us to the point where we can continue. So back to our cash flow. And this is effectively how you'll work your model. You'll work all these numbers first, and then at the end, you'll work out what funding it is that you require. In this case, you've been operating for a while now, you've got sales. So asset funders would be interested in backing you here. So you could probably go for some asset funding, some debt in that sense. And what do you need? Let's have a look. So we get as far as just below minus 400,000. So to keep us reasonably and avoid that low number there, perhaps we'll invest or we'll raise some capital financing on the new equipment, and we can probably finance some of the old equipment as well, because that equipment has still got a useful life. It's only 6 periods old, whatever that means in years. And we could probably put at this point 500,000. Actually, essentially, the 500 would need to come in. The 400 would need to come in at this point, because they will most likely what will happen is they'll pay the asset provider. But perhaps you do an asset raise here, a fundraise here on the old equipment at that point. Let's see what that does to your model. And as you can see, getting that funding in keeps you in the positive, which is the key thing here. The cash flow is positive, you remain in business, and your business continues to grow into the future. And typically in your model, you'd be looking to do this to sort of 3-5 years. That would be the sort of time frame, but depending on what the market opportunity was, of course. Now I'm gonna move across now to back to the model to close off and go back to our lovely slide, which showed us the profits and cash flow. And I'm conscious that that's been pretty much a whistle-stop tour into the world of finance, financial modelling in preparing you for your presentations. But just to sort of summarise, before we have any final questions, hopefully you can see that. You put your slides up. It's 2 slides, 1 or 2 slides in that 5-minute presentation. Tell them how much you want and show that clearly in the graph as the number that you borrow. What's it going to be used for? The nature of the spend. And then after the presentation, it's all about, because if the investors are interested initially and from that conversation, they're going to then want to do a more detailed due diligence. And that's when you will need to build the model and get a more sophisticated model with the various assumptions that you can play with. Investors will come up with questions as well. So, and they'll come up with questions about what's your key assumptions and what happens if it moves by this amount. So being able to show some of those sensitivities will be really good and give them the comfort that this is really something that they would want to invest in. Hopefully that gives you all you need. I know after today you might have a question, so feel free to contact Sylvia or any of the guys at Cambridge Cleantech. That's my email address, but Sylvia can pass on any questions that you might have. I realise we've tried to cover quite a lot this afternoon, so but hopefully that's set you up for your, I'm sure you'll make a great success of your investor pitches.
Thank you very much, Jeremy. Controlling the numbers can be sometimes quite overwhelming, and even going through your presentation today, you gave us some great insight, but I just feel like all these numbers, all these zeros that we need to control to make sure that our idea or the delegate ideas just take lights and grow and reach out to markets. So yeah, so thank you for that. Thank you for that. As you say, it was very quick. It's not meant for everybody to be an expert in finance straight away. There are people such as Jeremy being able to be here and being able to help you. So a few questions. I'm conscious of times. We're going to close the session in 5 minutes. First of all, we will share the slides. Jeremy, will you share also the example? The Excel spreadsheet.
Yeah, if I send it to you, Sylvie, shall I? And then you can.
Yes, please.
It's by no means. I should say it's by no means a model. You'll need something more sophisticated if you're going to get into deep conversations with investors, but I think it will help you for your initial pitches. So really happy to send that across.
Okay. Is there any pressing questions? Jeremy has to go for another presentation at 1 o'clock. So let's make sure we finish on time. I will call out for one question if any of you have something to say or comment. Rob from Ventive.
Hi, can you hear me?
Yes, we can.
Yes,
Great, thanks. Just a quick one. We've been presenting to investors, and on our financial summary slide, we've had a table, a summary table with revenue, profits, EBITDA, and reasonably lightweight. But I think your message seems pretty clear that graphs are way better for a 5-minute presentation. Is it best to remove that and replace it with graphs?
You don't have to, Rob. It's what you feel comfortable with. I have a preference for graphs, and most people are quite visual. People remember graphs better than they do numbers generally, and I'm an FD, so and I like numbers. So I think it does put the picture there straight away. It puts it into perspective, and given what you want to articulate, which is about how much you need to borrow, what the nature of the spend is going to be. This is what we're looking at in the first 5 years. It lends itself, but it really, there's more than one way to skin this cat. My preference is graphs, but there are some investors that say, "Oh, I don't like graphs." You never know whether it's right or not. But if you've got a clear graph like this one with the periods and the values on the left, and the clear sort of what the lines mean with the descriptions, then I think you should be fine.
Okay, great. Thanks, Jeremy. Great presentation.
Thanks.
Thank you. So yes, if you have any questions, just send it to myself and I will pass over to Jeremy. I will also send you the presentation and the Excel spreadsheet. And this is an indication, you have to feel confident when you're presenting of what you're saying. So if a graph is something you're confident with, just go for the graph. We're not asking you to review completely your presentation. We're just giving you more ideas. I hope it's not overwhelming. It's just here to help. Just take what you need for yourself and for your company. So thank you, Jeremy, and see you soon. And thank you, everyone, for joining us today.
Thank you, Sylvie. Thanks, everyone.
Bye.
Okay, thank you very much. Thank you.
Thank you.